Despite all the tariff drama, we are seeing stock markets rip once again here today. Take a look at the NASDAQ shooting higher here in the New York open session. Let's talk about what's happening here as well as why this market is moving higher. I'll give you a little bit of a hint. It has to do with rate cuts and strong corporate earnings. But is there the possibility of more volatility with tariff uncertainty? Let's talk about it. Welcome back to the channel, guys. We're taking a look at the NASDAQ, as I mentioned, which is pushing higher here this morning. And perhaps one of the core reasons for why that is that we are seeing more and more Fed officials coming out and saying they think rate cuts are appropriate. Fed's Kashkari sees 2 rate cuts this year as U.S. labor market cools. As we've discussed in recent videos, we've had a really disappointing latest NFP report showing a miss in jobs. You can see if we hover over this that the red dot represents what our forecast was, which was 106,000 jobs added. We only got 73. And of course, the revisions to the previous number were pretty abysmal, dropping from 147,000 jobs added to the economy in June. They dropped that number, revised it down to just 14,000 added. And so with labor data softening, the market is now saying, okay, we might actually be seeing some rate cuts coming down the pipeline. But why is it that the lack of jobs added are not scaring the market and spooking people? Well, it's because corporate earnings have been really strong relative to expectations. For example, if we take a look at our earnings report tracker here in the stock box, what you can see is that corporate earnings have been coming in strong for companies like Apple, putting up better earnings than expected, $1.57 per share compared to the $1.43 expected. Companies like Meta smashing it completely, $7.14 compared to $5.9 expected. And Microsoft also beating their expectations considerably. And so the market keeps going higher, even though we are getting headlines like from the Times of India, Donald Trump tariff news live updates. The U.S. president threatens higher tariffs on India in 24 hours. India stands firm on Russian oil trade. And the Trump administration does not like that India is buying oil from Russia, which in their mind is in support essentially of the Ukraine Russian war. And so we are seeing some things ramp up, especially between US and India, with new tariffs being piled on top this morning, Trump announced. Let's also take a look at gold during all of this and do a little bit of chart marking up. We have some clear resistance that we need to talk about just overhead at the 3440 level. We also have clear support just south of where we are, around 3260. We can mark this in green and talk a little bit about where we are with gold. So gold has been really range bound, but with lackluster jobs data and uncertainties around the tariff stuff, right, especially with that announcement we just got done discussing, the question is, post all these tariff, uncertainties, are we going to get another round of volatility? And could gold potentially be a beneficiary in all that? Could we see gold break out of this quadruple top that we put in the last few months? The reality of this is that gold has really been trading sideways and range bound, but with the Fed talking about cutting interest rates, some slowing economic data and uncertainties around tariffs, to me, gold actually looks like a possible breakout candidate. Specifically, what I'll be looking for is a break through this previous high, and as long as we can get some sort of decisive closure above it, I'd be looking for pullback opportunities to trade this thing long in my own personal account. I do think that the trend for gold remains intact on a longer term basis, especially if you look at like the weekly chart here. You can see overall we've been trending up very nicely, just consolidating sideways here recently. But in my view, consolidation at the highs is not necessarily a bearish thing. If anything, it is more of a bullish thing, as bulls kind of solidify their view here and are now looking for that next wave higher. Specifically, what we'd be looking for is some sort of geopolitical catalyst, or alternatively, just a rapid deterioration in the US economy could send gold soaring. And today's video is sponsored by Vantage. Vantage Markets allows traders outside of the United States to trade pretty much everything in one single brokerage using their comprehensive CFD platform. You can trade individual stocks, cryptocurrencies, currencies, commodities, indices, all in one singular brokerage using their CFD platform. They offer really low trading fees, they have a copy trading system, and they're offering for a limited time a very generous welcome bonus to people who sign up using the link that we have down below in the description of this video. So if you're interested in exploring Vantage and seeing what they have to offer, make sure to use that link so that you can take advantage of the welcome bonus that they're offering new clients. Do your due diligence, see if they're right for you. Now back to the video. One thing that's been kind of interesting too to discuss has been the bit of a fake out that we saw in the US dollar. For a little bit there, it looked like jobs data were really strong, inflation was remaining steady, and so that we could potentially see an upswing in the dollar. We had been all year seeing the dollar index be very weak. And in my view, we kind of got a little bit of a fake out with the jobs data, then the revisions to that data, right? So we had a huge, strong jobs print and we looked pretty solid. And then all of a sudden last week's NFP report really reversed things in a negative way. When it comes to the dollar index itself, I'm back to neutral. I really don't have a strong bias one way or the other. Perhaps the easiest way to visualize this is using our economic heat map. What we can see here, things like GDP growth, retail sales statistics, and PCE offer a little bit of supportive bullishness to the US dollar, but then you have a round of negative stuff, like manufacturing PMIs, services PMIs, the producer price index, and of course that really solid miss in NFP. These things are more negative towards the US dollar. So I'm back to a neutral position when it comes to the US dollar, and I'll wait for more signs of a more solidified upward trend, as well as some economic data to support that trend before touching this one on the long side for sure. Taking a look at the latest probabilities for the upcoming Fed meeting in September, you can see we are looking at a 91% chance that we are going to get a rate cut, at least according to the bond market. And taking a look at our December meeting, which is the last one of 2025, you can see that the bond market is kind of forecasting 2 to maybe even 3 rate cuts by the end of the year. Very big swings from where we were. A lot of people kind of thinking that we'd get 0 rate cuts this year. Now we're seeing 2 to 3, which 2 to 3 has been kind of my idea for most of this year. And we kind of were leaning back towards like 1 or 2, and now we've jumped over to 2 to 3. So it's anybody's guess exactly how many rate cuts we get, but with some deterioration in the labor market and Fed officials now kind of leaning into a little bit more dovishness, it's really becoming more apparent that more Fed officials are starting to see the light for rate cuts. And perhaps with the upcoming Jackson Hole Symposium, which is an annual event that the Fed does, maybe that will be officially where Powell kind of throws in the towel and says, okay, we're going to cut some rates. We'll see, coming up soon. A big winner in all of this has been the euro dollar, which has benefited tremendously from the uncertainty surrounding the US dollar. It actually came down and found support here recently around the 1.1420 level. Now looks like it wants to try and make a push back towards those previous highs around the 1.18 level. This has been a pretty strong trend here this year, and I wouldn't be surprised if it does continue. The British pound also found some support here. This one I'm not particularly bullish on though, because again, I think that the UK is also seeing some weakness in their economy, and so I would not be surprised if this one sort of ends up trading range bound to sideways. I do actually lean slightly more bearish if I had to pick a direction on this one. I'd be more interested in short trades than long trades when it comes to the British pound at this time. I think you've lost some of the momentum, and while yes, the euro and the pound are correlated to an extent, I do think that the pound is the weaker of the two currencies at this time. That being said, we did get some stronger than expected services PMI statistics out of the UK, putting the overall GBP impact here at a 50%. What that means, by the way, 50% of our indicators are suggesting bullishness. In terms of Europe, however, we have gotten a fresh round of data that I think is very interesting. Still leans bullish for the euro, but let's go through this really quick. GDP stats came in better than expected. Manufacturing PMI met expectations, giving us a neutral reading here for the euro. Services PMIs, however, missed expectations, being a little bit more soft or bearish for the euro. Same with retail sales, these missed expectations. And CPI was slightly higher than expected. That is bullish for the euro. Same with producer price index, which came in higher than expected. And unemployment ticked lower. That is also bullish for the euro, showing some stability in the labor market there. Remember that the way that I value whether something is bullish or bearish is all around what the market forecast around something is versus what actually appears. Our software essentially automates the process of how you can look at these different forecasts versus actuals and is scoring everything automatically. Then the software populates across all of the data that it's watching, the most bullish and bearish currencies, commodities, and indices across sentiment data, technical data, and economic data that we are tracking. Oil prices had a sharp move higher here this morning, only to reverse their course. This is definitely worth keeping an eye on, as rising oil prices could be sort of a contributor to inflation remaining high. Remember that high oil prices cause everything else to be higher in price. And so we do want to keep an eye on this to see what's developing. Of course, with the uncertainty around India, US, any sort of negotiation around oil being bought between India and Russia could complicate things in terms of supply and demand in the oil market. So keep a close eye on that. I'll definitely keep you guys updated if I find anything interesting when it comes to oil. If we did get some sort of sharp pop, like I said, any sort of escalation geopolitically can cause oil prices to spike, which can be a sticky problem for inflation. And as we finish out today, remember to check out our video sponsor, Vantage Markets. They're offering a really generous welcome bonus for a limited time and are the supporters of today's video. Thanks so much to Vantage for sponsoring, and thank you guys for watching. I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.